There's a cafe in Seattle that served the same customers for 11 years. Same corner, same menu, same owner. Last month it closed. Not because people stopped coming, because the owner finally looked at the numbers and realized he'd been losing money for 3 years straight. He just didn't know it. This happens more than you think. Most businesses don't fail because of bad products or lazy founders. They fail because of invisible problems. Issues that hide in plain sight while the cash register keeps ringing and the lights stay on. By the time the symptoms show up, the disease is already terminal. Let's talk about the silent killers. Picture this. You run a small online store. Sales are up 20% year over year. You're hiring. You just signed a lease on a bigger warehouse. From the outside, you're winning, but there's a number you haven't calculated yet. It's called customer acquisition cost, and it's about to ruin everything. Here's how it works. You spend money to get customers. Ads, influencers, discounts, referral bonuses, all of that has a price. Let's say you spend $40 in marketing to acquire one customer. That customer buys a product for $60. You made $20, right? Not even close. That $60 sale cost you $30 to fulfill. Product cost, packaging, shipping, payment processing fees, warehouse labor. Your actual profit on that transaction is negative $10. You just paid someone to shop at your store. But it gets worse. Most businesses don't track this in real time. They see revenue growing and assume profit is growing too. They hire more staff to handle the volume. They increase ad spend to keep the momentum going. They're pouring gasoline on a fire they can't see yet. The cash flow feels fine because sales are coming in, but every sale is digging the hole deeper. This is called unit economics, and if you don't understand it, you're building a time bomb. Here's the trap. Cash flow is a lagging indicator. It tells you what already happened, not what's happening now. You can have money in the bank and still be dying. In fact, some of the most dangerous moments in a business come right after big growth periods, because growth costs money up front. You buy inventory, you hire people, you invest in infrastructure. The bill comes now, the revenue comes later. There's a term for this. It's called growing yourself to death. In the 1990s, a toy company called Webvan raised hundreds of millions of dollars to deliver groceries online before anyone else did it. They were visionary. They were early. They expanded to 26 cities in 2 years. At their peak, they were delivering thousands of orders a day. The problem? Each delivery cost them more than the customer paid. They were losing money on every single transaction, and they scaled that loss to 26 cities. They went bankrupt in 2001, not because people didn't want grocery delivery, because the math didn't work. Fast forward to today, most of the gig economy runs on the exact same model, subsidized growth, selling below cost to capture market share. The difference is access to cheap capital. As long as investors keep writing checks, the math can stay broken, until one day it can't. Here's another invisible issue. Fixed costs versus variable costs. Sounds boring. It's not. Variable costs scale with revenue. You sell more, you spend more on materials. You sell less, you spend less on materials. Fixed costs don't care. Rent, salaries, software subscriptions, insurance, these bills show up whether you had a good month or a terrible one. Most founders underestimate fixed costs. They think about the product, the customer, the pitch. They don't think about the infrastructure required to keep existing. And infrastructure is expensive. A single full-time employee doesn't just cost their salary. It costs payroll taxes, benefits, equipment, training, management overhead. The real cost is often double the salary. Hire 5 people at $50,000 a year, and your actual annual burn is closer to $500,000, not $250,000. Now add rent. Add software tools, add legal fees and accounting fees, and the 50 small subscriptions you forgot you signed up for. Suddenly, you need to generate $100,000 a month in gross profit just to break even. Not revenue, profit. And here's the kicker. Once you commit to fixed costs, they're very hard to undo.
leases last years, employees have contracts, subscriptions auto-renew. You've built a machine that requires constant feeding, and if revenue drops even a little, the whole structure starts to crack. Let's talk about inventory. Physical products have a special kind of danger. You have to buy them before you sell them. That's obvious. What's not obvious is how much capital that traps. Say you sell skincare products. You order 5,000 units at $10 each. That's $50,000 locked up in boxes sitting in a warehouse. You sell them over 6 months at $30 each. Great. But for those 6 months, that $50,000 isn't working for you. It's just sitting there. And if trends change or your product doesn't sell, that $50,000 is now worth $5,000 in clearance sales. This is called inventory risk, and it killed more businesses than bad marketing ever did. There's also something called the cash conversion cycle. It's the gap between when you pay for things and when you get paid. If you're a retailer, you might pay suppliers in 30 days, but customers pay you immediately. Good. If you're a B2B service company, you might finish a project and then wait 60 days to get paid. Bad. That gap has to be funded somehow, by you. And if that gap widens or if more clients start paying late, you run out of cash even while your income statement looks profitable. On paper, you're making money. In reality, you can't make payroll. Here's where it all converges. Most of these problems are invisible because they're slow. They don't announce themselves. There's no alarm that goes off when your unit economics go negative or your cash conversion cycle stretches too long. You just wake up one day and realize you can't pay the next bill. And by then, your options are bad. You can raise prices and lose customers. You can cut costs and hurt quality. You can take on debt and buy yourself a few more months, or you can shut down. The cafe owner in Seattle chose the last one. He didn't want to, he just ran out of moves. The uncomfortable truth is, profit is an opinion, cash is a fact. You can have a profitable business on paper and still go bankrupt because accounting and reality don't always agree. Revenue recognition rules, depreciation schedules, accrual accounting, all of it creates a version of your business that exists in spreadsheets but not in your bank account. And most founders optimize for the wrong thing. They chase revenue because it's visible and exciting. They celebrate growth because it feels like winning. But growth without profit is just expensive theater. It looks impressive until the curtain drops. The smartest operators know this. They track the numbers most businesses ignore. Gross margin per unit, customer lifetime value versus acquisition cost, days sales outstanding, burn rate. They know exactly how long the runway is and what levers they can pull if things go wrong. The rest find out the hard way. So, what's the lesson here? The business issues you can't see are the ones that kill you. Not because they're complicated, because they're boring. They don't make good Instagram posts. They don't show up in pitch decks. They live in the background, compounding quietly, until one day they're the only thing that matters. And by the time you're losing money, it's not the beginning of the problem, it's the end.